You know, for decades, UK tax has been this incredible cat-and-mouse game. On one side, you've got taxpayers and their advisors, always looking for clever ways to trim down their tax bills. And on the other, you have the tax authority, HMRC, constantly trying to catch up. So let's dive into this battle of wits and explore the one huge rule change that completely redefined the entire game.
For the better part of a century, this quote right here was basically the law of the land. It's from a famous court case way back in 1929, and it pretty much said that paying tax was a game. If you were smart enough to find a loophole or structure your finances in a particular way, all totally within the letter of the law, then good for you. You were entitled to pay less tax. It was all about being astute, not really about fairness or what you intended to do.
Okay, but before we go any further, let's just clarify the battlefield here. Tax evasion? That's flat out illegal. We're talking hiding income, lying on your tax return, that kind of stuff. Then there's tax planning, which is not only legal but actually encouraged. Think about things like putting money into a pension or an ISA. But the real fight, the place we're exploring today, is tax avoidance. That's the murky gray area, using legal loopholes to get a tax result that Parliament probably never intended.
So as that gray area was getting exploited more and more, the government finally decided enough is enough. After decades of this back and forth, they brought in a powerful new referee to change the rules of the game for good.
And this is it, the General Anti-Abuse Rule, or GAAR for short. It was introduced back in 2013, and it's a really powerful catch-all piece of legislation. Its job isn't to get bogged down in all the tiny technical details. Instead, it's designed to step back and ask a much bigger question. Forget the letter of the law for a second. Is the spirit of what's happening here abusive?
And the way they define abusive is actually, well, it's fascinatingly simple. It's not about complex legal jargon. It just asks, are the steps you've taken something that could be considered a reasonable course of action? This deliberately broad definition completely shifts the focus from the technical rules to the overall spirit and intent of what you're doing.
So how does HMRC actually prove something is abusive? Well, they have to use something called the double-reasonableness test. And get this, it's not enough for HMRC to just think your plan is unreasonable. They have to prove that no one could reasonably think it was a reasonable course of action. I mean, that is a super high bar. In fact, it's so high that potential cases have to be reviewed by an independent advisory panel before HMRC can even move forward, which is a really key safeguard for taxpayers.
And you better believe this new referee is watching pretty much the entire field. The GAAR applies to nearly all major UK taxes. We're talking income tax, capital gains tax, corporation tax, inheritance tax, you name it. Its reach is incredibly wide. So, while the GAAR is the big, overarching rule, HMRC also targets some very specific plays in this game. So let's take a look at a few of the situations that they watch most closely.
Now, one of the most common areas of focus is something called a closed company. This might sound like a really technical term, but honestly, it could very easily apply to your smaller family-run business.
So what is a closed company? Well, it's basically any company that's controlled by 5 or fewer people. The law calls them participators. In the real world, this means the vast majority of small private companies and family businesses in the UK fit this description, and that puts them under a special kind of tax microscope. HMRC is on the lookout for specific red flags in these companies. The main one is when an owner, one of those participators, takes value out of the company without paying income tax on it. Think of, say, big loans from the company to its director that just never seem to get paid back. If that happens, you can bet a special tax charge is probably on its way.
And here's a perfect example of how the rules are constantly evolving to close any potential loopholes. Take a recent rule change. It used to be that you could argue a deal had a legitimate commercial purpose, even if there was also a huge tax benefit. Well, now the rules have tightened. If getting a tax advantage is just one of the main purposes, the whole thing can be challenged. The scales have definitely tipped.
And these little tweaks that sound kind of minor, they have massive consequences. The UK government estimates that this one change alone will bring in an extra £20 million a year. It just goes to show how these targeted changes can have a really significant financial impact.
But how does all of this actually play out in the real world? I mean, how does HMRC prove what a taxpayer's motives were, especially for something that was set up years and years ago? Let's go to the instant replay with a really fascinating recent case.
So this case involved a UK family home. The husband, Mr. Moran, transferred it into an offshore company based in Jersey way back in the 90s. After he passed away, his wife just continued to live in the house rent-free. Well, HMRC came along and argued that living rent-free was a taxable benefit that was coming from that offshore structure.
And here's the crucial part. The burden of proof was on Mrs. Moran. She had to prove a negative. She had to somehow demonstrate that avoiding UK tax was not one of the purposes when her late husband set this whole thing up almost 30 years earlier. I mean, can you imagine? That is an incredibly difficult position to be in.
So what happened? Well, this is where the whole thing fell apart for the taxpayer. HMRC found a smoking gun, an old note from a meeting with professional advisors back in 2002 that explicitly mentioned the purpose of the structure was for asset protection from the UK inland revenue. That one phrase pointed directly to a tax avoidance motive, and just like that, the defense crumbled.
That Moran case perfectly captures the state of play today. It shows that it's just not enough to follow the letter of the law anymore. Now, you have to consider the spirit of the law, and your intentions can be put under a microscope decades after the fact.
So, what's the big takeaway from all of this? The rules of engagement have fundamentally changed. Your best defense is to create a rock-solid paper trail. You have to document the clear, commercial, non-tax reasons for every single complex transaction. You basically have to work on the assumption that HMRC will come knocking eventually, and you need to have your answers ready to go.
And this leaves us with a final, kind of provocative thought. Has this new focus on motive and the spirit of the law actually made the tax system fairer, or has it just replaced one set of complicated rules with another, creating even more uncertainty and more gray areas for honest taxpayers? That really is the question at the heart of the UK's modern approach to tax.